What if you could turn your daily coffee budget into a $3 million portfolio, earning thousands of dollars in passive income every month? I get it. It can sound impossible at first. But here's the secret. Dividend stocks? They're your ticket to making money without breaking a sweat. It's like this. You buy into a company, and not only do you own a little piece of it, but it also sends you some of its profits, like clockwork, right into your bank account. Why is dividend investing even cooler in 2025? Well, it's all about that sweet spot between steady income and growth. Pick the right companies, and you're looking at cash coming in while your portfolio just keeps on growing. It's basically like having a money tree that not only grows, but also drops cash for you. So in this video, I'm gonna lay it all out. What dividend stocks are, why they're awesome, and how you can kickstart your very own dividend empire. Chapter 1. Dividend Stocks in 2025. Okay, let's chat about why dividend stocks are hitting the jackpot in 2025. Think about it. The market's all over the place. Inflation's still buzzing in everyone's ear, and we're all craving some kind of financial peace. That's where dividend stocks shine. They're like your safe haven amidst all this chaos. The beauty of stocks? They don't just sit there and maybe grow. They actually give you money on the regular. It's like getting paid just for holding them. Now, what's so special about 2025? Well, those companies that have been dishing out dividends like clockwork, your dividend kings and aristocrats, they're really showing their true colors now. They're not just getting by. They're actually doing great, no matter the economic weather. Plus, we've got sectors like energy and tech that are just exploding with potential. Renewable energy and AI are the big movers and shakers here. And let's not overlook reinvesting those dividends. This little trick, known as the dividend snowball, can really amp up your wealth over time. In 2025, compound interest isn't just some textbook concept. It's making real waves. So, if you're after a steady income stream or looking to build your portfolio over the long haul, dividend stocks are where it's at this year. Ready to get into the nitty-gritty? Let's continue. Chapter 2. How to start investing in dividend stocks. Alright, jumping into dividend stocks isn't as daunting as it might seem. Here's how to get rolling, step by step. First off, you'll need a brokerage account. This is basically your ticket into the stock market. Platforms like Robinhood, Fidelity, or Vanguard are user-friendly, especially for those new to this game. Setting up an account is a breeze. Just link your bank, and you're set to invest. Now, picking your stocks, that's where the excitement kicks in. Look for companies that have been paying and increasing dividends for ages, like your dividend kings or aristocrats. These companies have proven track records. When choosing, pay attention to things like dividend yield, payout ratio, and how their earnings are growing. And don't sweat if these terms are new. We'll unpack them later. For a strategy, consider dollar cost averaging. It's pretty straightforward. You invest in a fixed sum regularly, say $50 every week, no matter how the market's behaving. This helps you avoid the headache of trying to pick the perfect time to buy and lets you build your portfolio gradually. And here's the golden rule. Don't put all your money in one place. Diversify. Spread your investments across different industries, tech, energy, healthcare. This not only lessens your risk, but also ups your chances for consistent income. See, it's not rocket science. With a bit of effort and a regular habit, you're on track to create a portfolio that not only pays you, but also grows over time. Let's dig into those key metrics next. Chapter 3. Key metrics to evaluate dividend stocks. You don't need to be a numbers guru to get this, so let's break it down. First, there's the dividend yield. This one shows you how much cash you'll rake in from dividends compared to the stock's price. Say a stock's $100 and it gives you a $5 dividend each year. That's a 5% yield. High yields can be alluring, but watch out. Too high might mean the company's in hot water. Generally, aiming for a yield between 2% and 6% is a good balance. Then, there's the payout ratio. This tells you what slice of the company's earnings goes to dividends. If they're dishing out over 70 to 80% of their profits, it might not be sustainable down the road. A lower payout ratio often means the dividends are more secure. Don't forget about the dividend growth rate. Companies that bump up their dividends year after year are like finding treasure. It shows they're not just stable, but growing, which is great for your pocket. Look for a track record here, like with Microsoft or Realty Income. Dive into earnings growth and stability too. A robust dividend needs solid earnings behind it. Check if the company's revenues and profits are on an upward trend, or if they're all over the place. Declining or unpredictable earnings, that's a warning sign. Lastly, compare these metrics with others in the same sector. How does Chevron measure up against other energy companies? This context can help you pinpoint the real gems. Don't stress about remembering all this in one go. The more you look into it, the more it'll click. These numbers are your guide to finding those dividend stocks that'll help your wealth grow steadily over time. Chapter 4. Mistakes to avoid in dividend investing. Alright, let's cover some common goofs so you can sidestep them when diving into dividend investing. First off, don't get too excited about those super high yields. A stock promising 8% or 10% might seem like a gold mine, but often it's a red flag. It might mean the company's in trouble or can't keep up those dividends. Always look at the payout ratio and the company's financial health before you invest. Second, don't go all in on one stock or sector. If you've got too much in, say, tech or energy, you're asking for trouble. Spread your bets across different industries to cushion your portfolio against market swings. Another big no-no is ignoring dividend growth. A 2% yield that's growing can build a static 5% yield over time. Keep an eye out for companies that keep upping their dividends, like those dividend aristocrats. And don't forget to reinvest those dividends. Skipping this means you're missing out on the magic of compounding, which is what really builds wealth over time. Dodge these mistakes, and you'll be one step ahead of many beginners. Chapter 5. Best Sectors for Dividend Stocks in 2025. Alright, let's see where you should be looking for those juicy dividend stocks in 2025. Here's the rundown on the sectors that should be on your radar. First, technology might surprise you. Sure, companies like Microsoft aren't leading in yield, but they're all about steady growth and bumping up those dividend payments year after year. With AI and cloud computing taking off, tech's a good bet for those long-term gains. Then we've got energy. It's a bit of a mixed bag, but in a good way. You've got your traditional oil and gas guys like Chevron, offering solid yields and stability. And then there's the new wave, renewable energy companies like NextEra Energy, which are not only paying dividends, but are also riding the wave of green tech. Both types can give your portfolio some balance. Don't sleep on real estate investment trusts or REITs and utilities either. These sectors are your go-to for consistency. REITs like Realty Income give you dividends monthly, which is pretty sweet, while utilities like Dominion Energy are like the rock in your portfolio, especially when the economy's shaky. And don't forget healthcare. Companies like Pfizer are not just about dividends. They're backed by a steady demand for healthcare products, making them a solid choice. By spreading your investments across these sectors, you're not just aiming for income, but also setting yourself up for growth and stability. Chapter 6. Real-life examples of dividend success. Now, just to make it clear that dividend investing isn't some fairy tale, let me share some examples from real business world. First up, Warren Buffett. Back in 1988, he invested $1 billion in Coca-Cola. Fast forward to now, And those shares are pulling in nearly $1 billion in dividends every year. That's what happens when you stick with quality dividend stocks for the long haul and let compounding do its thing. Then there's Microsoft. They began paying dividends in 2003, and even though the yield wasn't sky high at first, they've upped their dividend every year since. If you would have dropped $10,000 into Microsoft a decade ago and reinvested those dividends, you'd be looking at a hefty return, thanks to both the growing dividends and the stock's price increase. It's not just the giants though. Consider Realty Income, dubbed the monthly dividend company. They pay dividends monthly, offering a consistent income flow. Investors who chose to reinvest those dividends over the years have seen their investments balloon, thanks to the power of reinvestment. These cases show us one key lesson. Dividend investing is about patience. Hold on to those stocks, reinvest your dividends, and watch your wealth grow over time. And the beauty of it? You don't need a fortune to start. Anyone can begin building their own success story with dividend investing. Chapter 7. Building a beginner-friendly dividend portfolio. Let's construct your first dividend portfolio. This is your financial starter kit. The goal is to strike a balance between growth, stability, and income. Kick things off with technology stocks, making up about 30% of your portfolio. Consider companies like Microsoft or Broadcom. They might not offer the highest yields, but they're known for steady growth and increasing dividends over time. Next, put 25% into energy stocks. Chevron's a staple for its dependable dividends, and Next Era Energy gives you a piece of the renewable energy sector, which is on the rise. For REITs, allocate around 20%. Realty Income, with its monthly dividends, is a solid pick. REITs are great because they're legally obligated to pass most of their income to investors, ensuring a steady stream. Finally, round out with 25% in utilities and healthcare. These areas are typically less volatile, providing consistent income. Look at companies like Dominion Energy or Pfizer for this slice of your portfolio. Here's the magic touch. Reinvest those dividends. This is how you amplify your portfolio into something that really builds wealth. Reinvesting buys more shares, which in turn generates more dividends, and the cycle continues. Begin with a modest investment. Keep consistent, and spread your bets across these sectors. Over time, this setup can not only bring in income, but also grow, paving the way for long-term financial success. And that's it for today. Start building your portfolio today, and watch your investments work for you. Don't forget to subscribe and share your favorite dividend stock in the comments. Experts say that